Picture this. You are standing in the checkout lane at your local grocery store.
Oh, we all know that feeling, just waiting for the damage.
Right. You've got your usual staples in the cart: milk, eggs, some chicken, maybe a box of Twinkies.
The essentials.
Exactly. And you are bracing yourself for that final number to flash on the screen. Because, I mean, for the last few years, that number has just been defying gravity, relentlessly eating away at your paycheck.
It's been brutal for everyone.
It really has. But today, miraculously, the number is lower. Your overall grocery bill actually went down.
Which is not something we're used to seeing lately.
Right. Your immediate reaction, naturally, is relief. You might even feel a little thrill, like you beat the system. But what if I told you that falling prices at the grocery store might actually be one of the most terrifying signals for your wallet, your job security, and like the entire global economy?
It feels completely backward, honestly.
Yeah.
We are so conditioned by the current economic narrative to view any price drop as a universal victory.
Like we finally won.
Yeah, exactly. A sign that things are finally getting back to normal. But the underlying mechanics behind why those prices are falling, like the invisible engine driving that deflation that makes all the difference in the world.
Okay, let's unpack this. Because we are looking at an incredibly dense stack of research today. We're pulling from a really comprehensive analysis by Tom Bilyeu, and it heavily features the macroeconomic breakdowns of Jeff Snyder.
Right, from Eurodollar University.
Yes, exactly. And our mission for this deep dive is to cut through all that heavy financial jargon, look past the rosy headlines you see on, financial news networks, and decode the real, unfiltered state of the global economy.
Because the surface-level data is really misleading right now.
It is. The notes we have cover everything from the surprisingly weak June CPI numbers to hidden signals flashing red in the Treasury bond market to the plunging demand for oil, all the way back to the lingering structural shadows of the 2020 pandemic.
And to really understand what's happening, we can't afford to isolate a single data point.
Right. No cherry picking.
Exactly. We aren't going to just look at a monthly jobs report or a single inflation print in a vacuum. The goal today is to connect the dots across global markets.
I love that.
Yeah, we're going to trace a line from the aisles of Walmart to the algorithmic trading desks of the Treasury bond market, all the way to the shipping lanes in the Strait of Hormuz.
Wow.
Because when you assemble those pieces, the narrative shifts dramatically away from this whole idea of a resilient consumer.
So let's start with the foundational concept that the source material flips completely on its head: deflation.
Right.
I always hear that inflation is the great destroyer of wealth. So logically, deflation must be the hero saving the middle class, right?
Consumption, yeah.
But Snyder and Bilyeu draw this incredibly sharp distinction between innovation-led deflation and crisis-led deflation.
Which is such a crucial difference.
It really is. From my reading of the notes, innovation-led deflation is essentially the story of the modern technological era. Things get cheaper because we get smarter at making them.
That is the healthy, productive side of the coin. Innovation-led deflation happens when technology, efficiency, and economies of scale reduce the cost of production.
Like TVs, right.
Exactly. Think about flat-screen televisions or computing power. I mean, 20 years ago, a massive, heavy TV with a terrible picture cost an absolute fortune.
And it took 2 people to lift it.
Right. Today, you can buy a vastly superior flat screen for a fraction of that price. And those prices fell because of better manufacturing processes, cheaper microchips, globalized supply chains.
So everyone wins in that scenario.
Absolutely. Consumers win, their standard of living increases, and the broader economy grows because the capital you saved on that TV can now be invested or spent elsewhere.
So nobody is crying about the deflation of consumer electronics. But then the source pivots to this darker concept, crisis-led deflation. And this is where the psychology of the consumer comes into play.
Yeah, and it's a very different kind of psychology.
Because it's not driven by some brilliant new microchip. It's driven by fear, paranoia, and a massive contraction in aggregate demand.
And historically, the ultimate cautionary tale for crisis-led deflation is Japan.
The lost decades.
Exactly. If we look back at the late 1980s, Japan experienced one of the most spectacular debt-fueled property and asset bubbles in human history.
I read this crazy stat about that once.
Oh, about the Imperial Palace.
Yes. To put it in perspective for you listening, at the peak of the bubble, The grounds of the Imperial Palace in Tokyo were estimated to be worth more than all the real estate in the entire state of California.
Which is just an unfathomable distortion of value. I mean, it makes no sense.
Literally insane.
Totally unsustainable. And when the Bank of Japan finally raised interest rates to pop that bubble, the resulting crash evaporated the wealth of millions of citizens and corporations almost overnight.
Just wipe them out.
Just gone. But what's critical for our discussion today is the psychological response to that wealth destruction. It triggered what economist Richard Koo famously called a balance sheet recession.
Okay, so instead of trying to grow or invest, the entire mindset of the country just shifted to survival and debt reduction.
Exactly. No matter how much the Japanese government tried to stimulate the economy over the following decades, lowering interest rates to zero, engaging in massive public works projects, the populace simply refused to spend.
Wow. They were just financially traumatized.
That's the perfect word for it, traumatized. Corporations focus obsessively on paying down debt rather than expanding. Consumers hoarded cash. And when an entire nation stops buying things, businesses are forced into a brutal corner.
They have to adapt or die.
Right. They have to continually slash prices just to survive, just to entice any marginal spending at all.
So the prices aren't falling because production is magically more efficient.
No, they are falling because the consumer is effectively on strike. It leads to economic stagnation, a total lack of investment, and what Japan experienced as multiple lost decades.
I'm stuck on one thing, though. Like, if I'm a consumer today and my grocery bill drops, I'm thrilled. I've got an extra 20 bucks in my pocket for the week.
Sure, it feels like a win.
How on earth does Wall Street look at my cheaper groceries and see the early warning signs of a Japanese-style economic collapse?
That's the disconnect we have to bridge.
Right, and to bridge that gap, the source material uses a really specific, relatable example that I think we need to walk through. The Twinkie cascade.
I love this example. It breaks it down so well.
Let's say I walk into Walmart and I notice the price of a box of Twinkies has dropped. Walmart didn't lower that price out of the goodness of their hearts, right? And Hostess didn't suddenly invent a magic, cost-free way to bake sponge cake.
Definitely not.
Walmart lowered the price because consumers, strapped for cash, simply stopped putting Twinkies in their carts.
What you are witnessing in that aisle is a real-time response to demand destruction. Walmart has sophisticated algorithms tracking every single barcode.
They know exactly what's moving and what isn't.
Down to the second. When the velocity of Twinkie sales plummets, an automated system eventually forces a price markdown to clear the inventory.
But again, playing devil's advocate here, if I still have my job and I'm walking through Walmart and I see those cheaper Twinkies, isn't that just a win for me?
It feels like it.
Yeah, it's like finding a $20 bill in an old winter coat.
Yeah.
I get the same sugary snack for less money. Why is my cheap Twinkie a red flag for the global economy?
What's fascinating here is how interconnected and ruthlessly optimized modern corporate margins actually are.
Yeah.
It feels like a localized win for you in that isolated moment.
Right.
But we have to look at the macroeconomic cascade, the domino effect of that cheaper Twinkie. Let's trace the math.
Okay, let's do it.
Walmart lowers the retail price of the Twinkies to incentivize you to buy them, but their wholesale cost what they pay. Hostess likely hasn't dropped.
Because of all the inflation we've already had.
Exactly. In fact, due to the lingering inflation of the past few years, the cost of the sugar, the packaging, and the diesel to transport those Twinkies might have actually gone up.
Oh, wow.
So Walmart is consciously choosing to squeeze its own profit margin just to maintain sales volume.
They are absorbing the loss to keep the inventory moving.
For a moment, yes. But the retail sector operates on razor-thin margins, often in the single digits. A massive corporation like Walmart will only absorb those shrinking margins for so long before Wall Street demands a correction to protect the bottom line.
So if they can't raise prices because consumers are too broke to pay them, they have to cut costs internally.
Right. And what is the most flexible, controllable cost for a retail business?
It's got to be labor.
Precisely. They can't easily negotiate a cheaper commercial lease, and they can't magically make electricity cheaper, but they can cut worker hours.
Jeez.
So Walmart shifts full-time employees to part-time to avoid cutting benefits. Or they implement a hiring freeze. Or eventually, they start laying people off.
And here is where the cascade really picks up speed, bleeding out of the Walmart ecosystem and into the broader economy.
This is the scary part.
Because now you have a former retail employee whose income just vanished. What do? They immediately shift into their own personal crisis-led deflation mode.
Exactly. They go into survival mode.
They completely alter their spending behavior. They aren't just skipping the Twinkies, they're skipping buying a new pair of shoes for their kid.
Right.
So they don't go to the local shoe store. Now, the independent shoe store owner looks at their own plummeting foot traffic and starts to panic. What do? They put their shoes on sale.
More deflation.
Exactly. They lower their prices, which creates more localized deflation, which squeezes their profit margins, and the cycle repeats.
The dominoes keep falling.
The shoe store owner has to let go of their part-time cashier. That cashier stops going to the local diner on Friday nights. The diner owner sees empty tables, lowers menu prices, and fires a waitress.
And that is the insidious nature of demand destruction. It is a self-reinforcing downward spiral. The source argues that this is the specific flavor of deflationary pressure we are beginning to see seep into the data.
Like a cry for help from businesses.
Exactly. It is businesses crying out, please buy this. We are desperate to move inventory to keep the lights on because the consumer base is completely tapped out.
Which brings us perfectly to how this phenomenon is actually showing up in the official government-issued numbers. Because if consumers are truly that exhausted, it shouldn't just be an anecdotal theory about Twinkies, you know? It should be measurable.
And it is.
Let's dive into the June Consumer Price Index, or CPI. The source material spends a massive amount of time analyzing this data set, specifically what economists call the core CPI.
Right, a very important distinction.
Now, just to make sure we are all on the same page, the core CPI is the inflation metric that intentionally strips out food and energy costs.
Yes.
The rationale I've always heard is that food and energy are just too volatile. Like a freeze in Florida ruins the orange crop, or a refinery goes offline in Texas and suddenly prices spike.
Which throws off the whole metric if you leave them in.
Right. So by stripping those out, the Federal Reserve supposedly gets a truer, smoother picture of the underlying structural inflation in the economy.
That is the textbook justification for focusing on core CPI. It filters out the noise of commodities to reveal the sticky, service level, and goods level inflation.
Right. And the source points out that in June, the supposedly sticky core CPI saw a fractional decline. It actually went negative month over month.
Which is huge.
And Snyder describes this not as a statistical anomaly or a minor blip, but as a marching band full of red flags.
A marching band. That's a great way to put it.
It was the weakest reading in the core rate since May of 2020.
May of 2020. Think about that.
I mean, May of 2020, we were in the teeth of unprecedented global lockdowns, businesses were forcibly shuttered, and unemployment was skyrocketing. To see a metric that weak today is staggering.
It really is.
But to truly understand why Snyder and Billy view this as a red flag rather than a victory over inflation, we have to understand what the Federal Reserve is currently terrified of.
Well, the Federal Reserve is an institution haunted by history.
Haunted.
Truly. Specifically, the phantom of the 1970s. During that decade, the United States experienced crippling runaway inflation under Federal Reserve Chairman Arthur Burns and later G. William Miller.
Right, before Paul Volcker finally had to step in.
Yes. Volcker had to basically crush the economy with massive interest rate hikes just to stop it.
Ouch.
Yeah. The 1970s inflation started with a supply-side energy shock, the OPEC oil embargo. But the terrifying part wasn't just the initial spike in gas prices. It was how that inflation bled into the structural psychology of the economy. Economists call this second-round effects.
I think we need to break down the mechanics of a second-round effect.
Yeah.
Because it's a term thrown around on financial TV constantly, but it's rarely explained in practical terms.
Okay, imagine a service provider.
Yeah.
Let's say a mid-sized landscaping company.
Okay.
Geopolitics cause energy costs to spike, so the diesel for their fleet of trucks and the gas for their industrial mowers suddenly costs 40% more.
Huge jump.
That initial energy spike is the first-round effect. Now, in a strong, resilient economy where consumers have healthy bank accounts, that landscaping company will simply reprice its services.
They just pass it along.
Exactly. They pass those higher energy costs directly onto their customers by raising their monthly landscaping fee from, say, $100 to $130, protecting their profit margins.
And the customer, because they have a good job and savings, grumbles about the price hike, but ultimately just pays it.
Yes, but it doesn't stop there. That customer is feeling the pinch of the $130 landscaping bill, plus their own higher gas bills. So they go to their employer and demand a cost-of-living raise.
Ah, I see.
The employer grants the raise to retain talent, but to afford that higher payroll, the employer has to raise the prices of whatever goods or services they sell.
And there it is.
That is the second-round effect. It becomes a vicious, self-perpetuating spiral. Energy prices push up service prices, which push up wage demands, which push up the prices of broad goods.
So suddenly inflation isn't just an oil shock.
No, it is deeply entrenched in the psychology and the math of the entire economy.
Wow.
The Federal Reserve looks at the massive fiscal spending and supply chain issues of the past few years and is absolutely terrified that we are on the precipice of a 1970s-style self-sustaining inflation spiral today.
Here's where it gets really interesting, though. The source material argues that the Fed is fighting a phantom.
A total ghost.
Right. They are deploying monetary policy for a 1970s battlefield, but the terrain has fundamentally changed. And the core reason brings us right back to the Walmart Twinkie cascade.
It all connects.
It does. Snyder argues that businesses today simply cannot pass on those higher input costs. Let's go back to our landscaping company.
Okay.
Their diesel costs spike. They want to raise their monthly fee to $130. But they look at their customer base and realize that if they hike the price, their customers won't just pay it and ask for a raise at work.
No, they can't.
The customers will just cancel the landscaping service entirely and mow their own lawns.
Because the modern consumer is fundamentally exhausted. They do not have the financial elasticity to absorb the price hike.
Which means the landscaping company is trapped.
Completely trapped.
They are forced to just eat the higher diesel costs, squeeze their own profit margins, and eventually, just like Walmart, they have to cut back on their own staff, delay buying new mowers, or shut down entirely.
Yep.
The second round effect that the Fed is so deeply terrified of isn't materializing as runaway inflation, it is mutating into demand destruction.
This perfectly highlights a profound disconnect in how the economy is being perceived versus how it is actually being experienced.
It's two different realities.
It really is. If you turn on a financial news network, you will constantly hear pundits praising the resilient economy or the strong American consumer.
All the time.
And they usually point to aggregate data like overall GDP growth or the fact that the S&P 500 is hitting all-time highs. But relying on averages completely masks the reality of a K-shaped economy.
Let's define the K-shaped economy for a second because it is the crucial lens for understanding this data.
Picture the letter K. An economic shock hits, and the recovery diverges violently into two paths. The top arm of the K represents asset owners, the wealthy, and large corporations.
The people who are doing great.
Exactly. If you own a home, a robust stock portfolio, or you locked in a 3% mortgage in 2021, you are doing incredibly well. Your net worth has likely surged.
Right.
But the bottom leg of the K represents the everyday working and middle class, people who rely primarily on their hourly wage or salary to survive, and who rent rather than own.
And they are struggling.
That bottom leg is being structurally crushed by the cumulative inflation of the past few years.
And the source points to consumer sentiment surveys to prove this, specifically calling out data from the University of Michigan and the New York Federal Reserve.
Which are very reliable indicators.
I love looking at sentiment data because it strips away the sterile academic models and just asks people, how are you actually feeling about your money?
Just straight to the point.
Right. And these surveys show a massive divergence. Everyday people aren't sitting around the dinner table terrified of a 1970s wage price spiral. They are terrified about their job security, their dwindling savings, and their inability to keep up with basic bills.
The Federal Reserve Bank of New York specifically tracks credit card delinquency rates.
Oh, this is the scary part.
And what we are seeing is a sharp, alarming uptick in the number of people falling behind on their payments, particularly among younger borrowers and lower-income households.
Because they're just running out of runway.
Exactly. They aren't spending because they feel confident. They are spending on credit cards because they are desperate to maintain their basic standard of living as the cost of necessities outpaces their wage growth.
Which completely maps to our daily lived experience. You sit down to do the monthly budget and you realize your dollar just isn't stretching as far as it did 3 years ago.
Not even close.
You've burned through whatever pandemic stimulus or savings you had. You aren't worried about macroeconomic theory. You are worried that if your car transmission blows or if your hours get cut at work, you have absolutely zero safety net left.
The net is gone.
The survey data and the credit card debt data perfectly corroborate the reality of a K-shaped consumer who simply cannot absorb another price hike, which is exactly why that core CPI number in June actually tipped negative.
But to truly understand why the consumer is so tapped out today, why they don't have the savings cushion they used to have, we have to look backward.
Okay, rewind the tape.
We have to examine what the source material refers to as the phase shift. The economic conditions we are dealing with right now, the high prices, the stagnant real wages, the credit card debt, they didn't just fall out of a coconut tree.
They didn't just happen overnight.
No, they are the direct, lingering, structural result of the unprecedented actions taken globally in 2020.
Now, Tom Bilyeu's analysis of 2020 touches on some highly debated geopolitical territory.
It definitely gets intense.
Yeah. The source material features some very intense claims regarding the origins of the virus in China, strong condemnations of government motives, and arguments that crises were leveraged for draconian control.
Which is a lot to unpack.
Right. And our purpose on this deep dive is not to wade into those political debates or validate those specific geopolitical claims.
We're sticking to the economics.
Exactly. However, if we strip away the political arguments and purely focus on the mechanical economic framework he builds around 2020, it is fascinating. He argues that regardless of the politics, the global economy experienced a massive phase shift, a fundamental disruption that permanently altered the baseline of commerce.
And from a purely macroeconomic perspective, the mechanics of that phase shift are undeniable.
Yeah.
Think about the basic equation of supply and demand.
Econ 101.
Exactly. In 2020, we saw governments and central banks worldwide coordinate to inject trillions of dollars in fiscal stimulus and monetary liquidity directly into the economy.
Just massive amounts of cash.
It was an unprecedented expansion of the money supply. At the exact same time, due to the lockdowns, global supply chains were effectively frozen.
It's the ultimate textbook recipe for explosive inflation.
Unmatched in modern history.
You suddenly have an absolute ocean of new, freshly printed money chasing a dramatically shrinking pool of goods and services because the factories are closed and the cargo ships aren't moving.
The source describes the resulting price increases not as a normal, gradual inflationary curve, but as a violent vertical spike on the charts.
Like rocket ship.
It was a structural reset.
Yep.
Prices didn't just go up and eventually come back down. They reset to a permanently higher plateau.
A new normal.
But understanding why the damage from that specific moment in 2020 is still manifesting as demand destruction years later requires looking at the complexity of the global system.
And this is where I was really struck by a couple of analogies the source used. Let's explore the idea of the 9-year-old child missing school.
That analogy perfectly illustrates the concept of delayed structural consequences.
Right. Bilyeu makes the point that if you take a 9-year-old child, someone in their most crucial developmental years, and pull them out of a physical school environment for 2 years, making them learn exclusively by staring at a screen in their bedroom, you might not see the catastrophic damage immediately.
Right. On the surface, they seem okay.
In the moment, they are sitting at home, they are safe, they're doing their digital worksheets, and they seem fine. But the knock-on effects, the lack of vital social conditioning, the missed foundational building blocks of learning, the subtle psychological impacts of isolation, those don't manifest until years later.
They are hidden.
You won't fully realize the true cost of those 2 missed years until that kid is trying to navigate the complex social hierarchy of high school, or trying to enter the workforce, or struggling to form complex emotional relationships as an adult.
The bill comes due later.
The damage is invisible in the short term, but deeply, perhaps permanently, structural in the long term. The source argues the global economy functions exactly the same way.
The global economy is not a light switch.
Good analogy.
You cannot just flick it off, plunge it into darkness, and then flick it back on a year later and expect the bulb to burn just as brightly.
It does work like that.
When you freeze global commerce, drastically alter deeply ingrained consumer behaviors overnight, and inject unprecedented liquidity to mask the immediate pain, you are setting off complex chain reactions that take years to fully mature.
The slow burn.
Many people assume that once the lockdowns ended and the ports reopened, prices would just snap back down to 2019 levels. But as the source points out, that's not how a phase shift works.
Once it shifts, it stays shifted.
The rate of inflation eventually slowed down, yes, but prices were growing from that new, astronomically high peak. The pain of the phase shift was permanently baked into the cost of living, while wages for the bottom half of the K-shaped economy failed to keep pace.
Which brings us to the second analogy, which is incredibly visceral, the worm gum in the hair.
Oh, this one paints a picture.
It really does. Bilyeu argues that bad economic policies, specifically the decision to violently shut down the global supply chain, isn't like a localized tumor.
Right.
You can't just isolate the bad policy, surgically pluck it out like a frozen piece of gum, and expect the host to be completely fine the next day. The policy is hopelessly entangled.
It is entangled because the modern global supply chain is arguably the most delicate, complex network ever created by human civilization.
It's a miracle it works at all, honestly.
It really is.
Yeah.
It is composed of millions of interconnected suppliers, manufacturers, shipping lines, port authorities, and retailers, all operating on a philosophy of just-in-time delivery to maximize capital efficiency and minimize storage costs.
So there's zero slack in the system.
Zero. When you intentionally halt that network, you don't just pause it. You create millions of microfractures.
Like breaking a piece of glass.
A tiny microchip manufacturing plant shutting down in Taiwan delays the assembly of a truck in Detroit.
Huh.
That lack of inventory bankrupts a mid-sized dealership in Ohio.
Wow.
That dealership lays off 30 workers who then immediately default on their mortgages, putting stress on a regional bank.
It just spreads everywhere.
It is, as the source vividly puts it, like getting a massive wad of sticky, stringy gum mashed deep into long hair.
Yuck.
You can't just pull it out. You have to painstakingly, agonizingly untangle it strand by strand. And the reality is, you are going to lose a lot of hair in the process. We are currently living through the painful reality of losing that hair.
And to highlight just how historically unprecedented this entanglement was, the source makes a really compelling historical comparison to the 1918 Spanish flu.
Which is a wild comparison to think about.
They note that the Spanish flu killed an estimated 30 to 50 million people globally, and it did so coming right on the heels of the absolute devastation of World War I.
Just unbelievable tragedy.
And yet, despite that unimaginable, staggering scale of tragedy, the world did not institute the kind of total synchronized economic lockdowns that we saw in 2020.
They kept moving.
The source uses this comparison to underscore just how uncharted the economic response to the 2020 pandemic was. We essentially ran a global macroeconomic experiment with zero historical precedent, fundamentally altering the baseline of supply and demand.
A massive experiment.
And we are currently living through the long-term structural consequences of that experiment, manifesting as a middle class that is simply breaking under the pressure of permanently higher prices.
Which perfectly closes the loop on why we are seeing demand destruction in the CPI numbers. The consumer is exhausted because they are carrying the structural weight of the 2020 phase shift.
Okay, so we've looked at the micro level with the Twinkies at Walmart, we've analyzed the macro level government data with the core CPI, and we've explored the historical theory of the 2020 phase shift.
A lot of ground covered.
But let's pivot to present-day action in the financial markets, because I look at this and think it's one thing for a YouTube analyst, or even for us on a deep dive, to sit back, look at historical analogies, and theorize that the economy is structurally weak.
Talk is cheap, right?
Exactly. It's entirely different when we ask, what do the people with actual millions or billions of dollars on the line believe? Where is the institutional smart money placing its bets?
This is where the macroeconomic theory becomes incredibly empirical. Because narrative is cheap, but the bond market requires actual capital at risk.
Put your money where your mouth is.
Exactly. The source material spends a significant amount of time breaking down a very specific corner of the financial world, the TPS market.
Let's clearly define what TIPP are because it's a critical piece of the puzzle. TPS stands for Treasury Inflation Protected Securities.
Correct.
From my understanding, it is a type of U.S. government bond. But unlike a regular Treasury bond, which pays a fixed interest rate, a TPS bond is mathematically designed to protect the investor from inflation.
Right, it's a built-in shield.
So the principal value of the bond actually adjusts upward if the official inflation rate goes up, and it adjusts downward if deflation occurs. Is that an accurate read?
That is exactly right. TPS are an explicit hedge against inflation. And the specific metric the source focuses on, the key signal we need to decode, is what's called the break-even rate.
Okay, break that down for us.
Without getting bogged down in an agonizingly deep dive into financial mathematics, the break-even rate is essentially the difference in yield between a regular Treasury bond and a TPS bond of the same maturity.
Okay, I'm following.
It is a real-time, mathematically pure measure of how desperate institutional investors are for inflation protection.
So if the break-even rate is rising, it means the market, which is the collective intelligence of global banks, hedge funds, and pension funds, believes inflation is a severe incoming threat.
Yes.
And they are willing to pay a massive premium to protect their capital.
Yes. And conversely, if the break-even rate is falling, it means the demand for inflation protection is drying up. The market is looking at all the data in the world, running their models, and concluding, we do not see sustained inflation as a major risk. In fact, we see the opposite.
I thought the pop culture analogy the source used here was brilliant for contextualizing why this matters.
Game show one.
Yeah. Looking at the TPS market is basically like using the Ask the Audience lifeline on the game show Who Wants to Be a Millionaire.
It's perfect.
You are sitting in the hot seat, you are staring at a complex economic question, and you aren't sure of the answer, so you pull the crowd.
Except in this case, the crowd isn't a random studio audience.
Right.
It is made up of the most ruthlessly educated, data-driven, merciless institutional investors on the planet. And they aren't just pushing a button on a keypad. They are backing their votes with billions of their own hard-earned dollars.
Skin in the game.
Exactly. It's a way to cut through the political spin, ignore the media headlines, and see what the financial world actually believes is going to happen based on how they are positioning their money.
It's arguably the most powerful signal in finance because it aggregates an unfathomable amount of disparate global information into a single actionable metric.
And what that metric is saying right now is stunning.
Tell me.
According to Snyder's analysis, since late May and into June, TPS break-even rates have absolutely plummeted.
Plummeted.
They haven't just experienced a minor downward tick. They have made a huge, rapid move lower. The institutional audience is screaming with their wallets that inflation is not the primary risk.
Okay, I want to pause here and make sure I'm fully wrapping my head around the implications of this.
It's a lot to take in.
Because if I'm hearing you right, we are currently living in a world where there are active, highly publicized political discussions about implementing sweeping new global tariffs.
True.
We're watching a literal armed conflict in the Middle East involving Iran, which historically is the #1 catalyst for massive oil price spikes.
Usually a guarantee for inflation.
Right. And yet, despite these massive, incredibly obvious, highly inflationary supply-side threats staring them right in the face on the front page of the newspaper every day, the smartest money in the room is looking at the board and aggressively betting against long-term inflation.
Yes, they are.
How incredibly weak does the underlying global economy have to be for that mathematical bet to make sense to a hedge fund manager?
If we connect this to the bigger picture of the Twinkie cascade and the tapped-out K-shaped consumer, it makes perfect, terrifying sense.
Okay, walk me through it.
The financial markets believe that demand destruction is a much stronger gravitational pull right now than any geopolitical supply-side shocks.
Demand destruction wins.
Exactly. The market is looking at the American middle class, the max-out credit cards, the rising delinquency rates, the shrinking retail profit margins, and they are concluding that the consumer simply cannot support higher prices, regardless of what happens in the Middle East.
That because you can't squeeze blood from a turnip.
You really can't. Even if a war makes oil significantly more expensive to pull out of the ground and refine, the bond market is betting that the global economy will just consume drastically less oil because they can't afford it, rather than paying the higher price. The downward pressure of a structurally sick economy is completely overpowering the upward inflationary pressure of geopolitical conflict.
That is wild. The idea that a war in the Middle East wouldn't cause inflation because we are literally too broke to buy the expensive oil.
It's a sobering thought.
And there is a specific nuance in the TPS market that the source highlights, which makes this bet even more stark. They look at the yield curve, specifically comparing the 5-year break-even rate to the 10-year break-even rate.
This is a really crucial detail.
And currently, the 10-year break-even rate is lower than the 5-year. Now, I know yield curve inversions are historically bad news, but break down exactly why this specific inversion in inflation expectations is a flashing warning sign.
It requires a bit of logic, but it's very intuitive. Normally, in a healthy, steadily growing economy, you expect inflation to be slightly higher over a longer time horizon.
Just natural.
Right. There is simply more time for population growth, wage increases, technological expansion, and economic compounding to occur over 10 years compared to 5 years. So, mathematically, the 10-year break-even rate should logically be higher than the 5-year rate.
So what happens when it flips?
When that relationship flips, when the 10-year rate is persistently lower than the 5-year again, the institutional market is sending a very specific, grim message.
What are they saying?
It is saying, okay, maybe we acknowledge there might be a short-term volatile blip in prices over the next few years due to some immediate supply chain disruption or a localized conflict.
Okay, little bump.
But long-term, structurally, over the next decade, We expect the global economic engine to stall out so violently that inflation will actually be weaker 10 years from now than it is 5 years from now.
That's horrifying.
It is a multi-billion-dollar bet on long-term, entrenched macroeconomic stagnation.
They are essentially betting that the Twinkie Cascade isn't just a blip, it is going to define the entire next decade of the global economy.
Yes. The bond market is effectively taking a victory lap, as Snyder puts it, because it predicted the weakness we are now seeing in the official June CPI data long before the government actually published the report.
They saw it coming.
The institutional investors read the underlying mechanics of demand destruction before it ever showed up in the trailing data.
Okay, so the bond market, the realm of government debt, complex mathematics, and institutional investors is flashing these massive warning signs about demand destruction.
Sirens blaring.
But the source material doesn't start there. Because if you really want to confirm a macroeconomic theory of this magnitude, you need to look across totally different asset classes to see if the story holds up.
You need corroboration.
And Billy and Snyder argue that the energy market, specifically the incredibly complex world of oil futures, is telling the exact same story as the bond market.
And this is vital corroboration because the energy market is arguably the most physically grounded market in the world.
Right, it's not just numbers on a screen.
Exactly. Bonds are ultimately abstract financial instruments, promises on a piece of paper. But oil is a physical commodity that powers literally everything in the modern world: global shipping fleets, heavy manufacturing, transportation, commercial agriculture.
You can't fake oil consumption.
No. If the physical demand for oil is dropping, it means the actual physical activity of the global economy is slowing down.
The source takes a really deep dive into the current pricing structure of WTI West Texas Intermediate crude oil futures. Now, for the listener, a futures contract is essentially an agreement to buy or sell a specific amount of a commodity, like a barrel of oil, at a set price on a specific date in the future.
It's a way to lock in a price.
Right. It's how airlines lock in fuel prices months in advance. And because of the ongoing conflict involving Iran and the significant disruptions we've seen in the Red Sea and the Strait of Hormuz, where massive amounts of global oil transit, the front month contracts spiked in price.
Which makes sense.
Right. The front month means the oil that is being delivered immediately right now. And that logic makes total sense. There's a war, ships are being attacked, supply is threatened today, so the price of oil today goes up.
Basic supply and demand.
But the anomaly, the massive twist that Snyder points out, is what happens when you look further down the calendar. The contracts for oil delivery in November are actually down. They are actively selling off.
This condition, where the current immediate price of a commodity is higher than the future price, is known in the commodities market as backwardation.
Okay, so explain the mechanics of backwardation. Why wouldn't a speculator just look at that and say, wow, November oil is cheaper, I'll just buy a bunch of that today and make a profit?
Because of the physical realities of the commodity.
Yeah.
If you buy cheap November oil today, you have to physically store it, insure it, and pay the cost of carrying that inventory until November.
Oh, that makes sense. You can't just put 1 million barrels of oil in your garage.
Right. The market structure of backwardation essentially says, yes, there is an urgent, localized panic today because of the geopolitical conflict in the Middle East, so commercial buyers will pay a steep premium for oil right now to ensure their cargo ships can sail this week.
They need it now.
Exactly. The convenience yield of having the oil today is very high. But when those same massive commercial buyers and institutional speculators look 3, 4, or 6 months out to November, they are actively betting that oil will be significantly cheaper.
Why?
Because, just like the bond market, they see demand destruction coming like a freight train.
They believe the global economy is going to slow down so severely by November that factories and shipping lines simply won't need as much oil, completely neutralizing any supply threats caused by the war in the Middle East.
Exactly. And the source makes a brilliant historical comparison here to really hammer this point home, taking us back once again to the 1970s.
Because the obvious counterargument is, wait, geopolitical conflict in the Middle East always causes inflation.
Right. In 1973, we had the infamous OPEC oil embargo. Geopolitics severely restricted the supply of oil to the West.
And the result was rampant, devastating inflation.
Prices skyrocketed. There were physical lines of cars wrapped around the block at gas stations, and it triggered those exact second-round effects we discussed earlier.
So the multi-trillion-dollar question, is if an oil supply shock in 1973 caused massive global inflation, why is the oil futures market betting that a supply shock today will cause deflation and demand destruction?
What is the fundamental structural difference between the consumer then and the consumer now?
This is where the historical context is just incredibly illuminating. Snyder hypothesizes that the difference lies entirely in the underlying financial health of the consumer leading up to the crisis.
It's all about the starting point.
Right. In the 1950s and the 1960s, leading into that 1973 embargo, the American middle class was experiencing genuine, robust, real wage growth.
The golden age of the middle class.
The post-World War II economic boom was incredibly real. The middle class was expanding, unions were strong, and a single income could often support a family, buy a home, and build savings.
They had a massive buffer.
So when the massive oil shock hit in 73, consumers actually had a financial cushion. They had savings in the bank. They had rising real incomes. They were flush with cash.
So they could absorb the shock.
Exactly. They grumbled about the price of gas. They hated waiting in line, but they ultimately paid the higher price, and they kept participating in the broader economy.
They kept buying appliances and going on vacations, which allowed that inflation to spiral upward through the entire system.
But contrast that economic reality with the reality of today.
It's a completely different world.
As we've discussed with the K-shaped economy, real inflation-adjusted wages for the bottom half of the American economy have essentially stagnated for decades.
No wage growth.
The intense, vertical post-2020 inflation has rapidly eaten away whatever temporary pandemic stimulus savings existed.
The modern consumer does not have a cushion.
Zero cushion.
They are operating on a razor's edge of maxed-out credit cards and rising auto loan delinquencies. So when a supply shock hits today, and gas prices threaten to rise due to conflict in the Strait of Hormuz, the modern consumer doesn't just absorb the cost and keep spending.
They break.
They break.
They change their behavior entirely. They cancel the summer road trip. They consolidate their grocery runs to save gas. They stop buying the Twinkies at Walmart just to afford the gas to get to their shift at work.
And that behavioral shift, forced by a lack of capital, results in massive demand destruction rather than sustained inflation.
The spiral goes down instead of up.
Yes. The global economy cannot inflate if the primary engine of consumption, the American middle class, simply lacks the capital to fund the spiral. The money simply isn't there in their personal bank accounts to sustain higher prices.
And this isn't just an American phenomenon. To truly grasp the sheer scale of this global demand destruction, the source brings in the ultimate geopolitical wildcard.
Oh, this is fascinating.
The China factor. This part of the analysis honestly blew my mind, because we tend to view all of these macroeconomic issues through a very localized U.S.-centric lens.
We get tunnel vision.
We focus on the Fed and the U.S. consumer. But the source points out that the two largest economies in the entire world are fundamentally structurally sick at the exact same time.
Which is unprecedented.
We've covered the U.S., the tapped-out K-shaped consumer dealing with the echoes of the 2020 lockdowns. But China is grappling with its own massive homegrown structural illness.
A catastrophic, completely frozen housing crisis.
It is difficult to overstate the importance of the Chinese real estate sector to the global economy.
It's massive. For the past 2 decades, China transitioned from an export-led economy to an economy heavily reliant on debt-fueled infrastructure and real estate development.
Building cities out of nowhere.
Exactly. The real estate sector, including all related services and construction, has historically accounted for up to 30% of China's entire GDP.
30.
It was a massive, insatiable engine of domestic growth, and crucially, an absolute behemoth consumer of global commodities: steel, copper, cement, and energy.
But that model relies on constant expansion.
Exactly. And the model broke. We saw the collapse of massive developers like Evergrande and Country Garden, and a crisis in the local government financing vehicles that funded a lot of this infrastructure.
Dominoes fell.
When a sector that makes up nearly a third of the second largest economy in the world violently seizes up, the ripple effects across the globe are staggering.
And the source uses the oil market, specifically the demand for diesel, to illustrate just how bad the internal situation in China actually is.
It's the perfect indicator.
Despite the massive supply disruptions in the Strait of Hormuz, despite the geopolitical chaos threatening global shipping lanes, China has astonishingly been able to build up its strategic oil reserves over the past several months.
Which, on the surface, makes absolutely no sense.
None. If global supply is threatened by war, you would assume a massive energy importer like China would be struggling to get enough oil just to keep their current factories running, let alone have excess capacity to stash away in strategic reserves.
It only makes mathematical sense when you factor in catastrophic systemic demand
Oh,
destruction.
okay, lay it out.
China has been able to stockpile oil because its domestic demand for consumer gasoline and, critically, its demand for industrial diesel has plummeted so severely.
Because diesel is the engine of construction.
Diesel is the ultimate proxy for industrial and construction activity. It powers the massive earth-moving machinery, the transport trucks, the cargo trains, and the factory generators.
So if diesel drops,
The fact that diesel demand is plunging means the factories aren't running as hot. The construction machinery that was supposed to be building endless high-rise apartments and new ghost cities sits totally idle, so it isn't burning fuel. The internal Chinese economic engine has slowed down so dramatically that even with restricted global supply coming out of the Middle East, they have a massive surplus of energy relative to their collapsed domestic needs.
I have to marvel at that for a second, because for 50 years, essentially half a century, the golden rule of macroeconomics has been that global energy demand is practically inelastic.
Right, it doesn't bend.
People need to drive to work, goods need to be transported, factories need to produce. You can't just decide to stop using energy. The idea that you could see a structural drop in demand so severe that it actually breaks that inelasticity, that people are driving that much less, that the industrial giant of China is burning that much less diesel, it is a profound, almost scary signal of a global economic standstill.
It's not a mild cyclical recession.
No, it's a structural seizing up of the gears of global commerce.
It is the Walmart Twinkie cascade, but played out on a massive geopolitical scale.
I see it now.
Connect the dots. If the American middle-class consumer stops buying cheap plastic goods from a big-box retailer because they are tapped out, then the Chinese factory that manufactures those goods doesn't need to run a third shift.
Right.
If the factory doesn't run a third shift, they don't burn as much diesel. If they don't burn as much diesel, overall global oil demand drops, which mathematically shows up as a price drop in November SEC.
Yeah.
Futures contracts on the financial exchanges in New York.
It's a perfect circle.
It is all intimately, inextricably connected. And right now, every single one of those interconnected nodes, the retail aisle, the bond market, the commodities exchange, is flashing a synchronized warning sign about severe demand destruction.
Which brings us full circle, from the grocery store aisle to the global shipping lanes. Let's briefly recap the journey we've been on today, because we've covered an immense amount of deeply complex ground.
It's a lot to process.
We started by dismantling the prevailing narrative that all falling prices are inherently good, exposing the dangerous reality of crisis-led deflation.
The Jan scenario.
Right. We walked through the cascading effects of demand destruction. The idea that the shoe store down the street might fire a cashier simply because you stopped buying snacks at Walmart. We looked at the reality of the K-shaped consumer, tapped out, maxed out on credit, and terrified, forcing the June core CPI numbers into a fractional decline that totally shocked the models at the Federal Reserve.
We examined the lingering, invisible structural shadows of the 2020 phase shift.
The missing school years and the gum in the hair.
Exactly the reality that you cannot simply freeze the global supply chain, pump the system full of trillions in printed liquidity, and expect it to magically untangle itself without severe, decade-long consequences.
And finally, we followed the smart money. We saw the ruthless institutional investors in the TPS bond market betting heavily against long-term inflation, signaling structural stagnation.
The ultimate ask the audience lifeline.
And we saw the commodities market pricing in a severe drop in future oil demand, confirming that the economic sickness spans from the American middle class all the way to the brazen, collapsing real estate markets of China.
The picture that Bill Yu and Snyder paint in this analysis is undeniably grim, but it is deeply necessary to understand if you want to navigate what is coming.
You have to face the music.
It forces us to look past the surface-level metrics, ignore the political spin, and recognize the immense structural fragility underneath the global economy.
Which leaves us with a final lingering thought and extrapolation based directly on everything we've discussed today. The source paints a picture of the two largest global economies actively masking deep structural sickness.
Both of them at the same time.
You have the U.S. leaning heavily on maxed-out credit cards and government debt to maintain the fragile illusion of a strong consumer. And you have China grappling with a frozen housing market that has completely crippled its internal demand and industrial output.
It's a house of cards.
This raises an incredibly important, almost existential economic question. If the entire global supply chain is currently being precariously propped up by these two temporary failing band-aids, what happens to global trade the moment the American consumer's credit card is finally unequivocally declined at the exact same time China's domestic infrastructure demands dry up entirely?
That's the terrifying unknown.
When the two great engines of the modern world, American consumption and Chinese production, fail simultaneously, are we just looking at a localized traditional recession? Or are we standing on the precipice of a fundamental, painful rewiring of how global commerce actually operates?
It's the biggest question of our time.
It is a heavy, massive question, and it is exactly the kind of structural concept you should be pondering the next time you are standing in that checkout lane, looking at your receipt, wondering why the math feels off.
Because it is off.
Falling prices might feel like a welcome relief today, but if you look closely at the mechanics, they might just be the quiet before a much, much larger storm. Thank you so much for coming along on this deep dive with us. Keep looking past the headlines, keep following where the smart money is actually flowing, and never stop questioning the narrative of a resilient economy. Until next time, stay curious.